Show me the money, folks. Matter of fact, let's get it together. Today, we're diving into something super important for your financial future. How to make sure your investments are actually working for, well, you. Because let's be honest, nobody wants to throw their hard-earned money into something that's just going to get eaten away by hidden fees, right? If you're investing in mutual funds, you need to stick around, because these 10 money hacks could save you a ton of money over the lifetime of your investments. We're talking potentially tens of thousands, even hundreds of thousands of dollars in savings, just by making a few smart decisions. Whether you're just starting out or you've been investing for a while, these tips are going to give you the knowledge you need to take control of your financial future and start maximizing your returns. So, let's get right into it. The first thing you need to understand about mutual funds is the concept of expense ratios. An expense ratio is basically a fancy way of saying how much of your money the fund company is going to take every year just for managing your investments. Think of it like this. You've got a pizza, and the expense ratio is the slice that the pizza delivery guy gets to take before he gives you the rest. The bigger the expense ratio, the smaller your slice of the pie. Now, these fees might seem small, maybe 1% or 2%, but they add up over time. A 1% expense ratio means you're paying $1,000 every single year just to hold that investment. The crazy part is, most people don't even realize they're paying these fees because they're deducted automatically. But by understanding expense ratios and actively seeking out funds with lower fees, you can keep way more of your hard-earned money working for you. Now that you understand the importance of expense ratios, let's talk about how to actually compare different mutual funds. The first thing you want to do is look beyond just the fund's name and marketing materials. Those can be deceiving. Instead, focus on the hard numbers. Look at the expense ratio, of course, but also pay attention to the fund's historical returns. However, remember that past performance isn't always a guarantee of future success. Consider the fund's investment strategy, the types of companies or assets it invests in, and how well it aligns with your own risk tolerance and investment goals. Don't be afraid to use online tools and resources to help you compare different funds side by side. Websites like Morningstar and Yahoo Finance can be super helpful for this kind of research. We've already talked about expense ratios, but let's dive a little deeper into the specific types of fees you'll encounter with mutual funds, starting with management fees. These fees are basically the salaries of the fund managers, the people who are making the investment decisions. The problem is, many actively managed funds have high management fees that eat into your returns year after year, even if the fund doesn't actually perform very well. That's why it's so important to pay close attention to these fees and compare them across different funds. And here's a pro tip. Consider index funds, which tend to have much lower management fees because they simply track a specific market index, like the S&P 500. Chapter 4. Index funds versus actively managed funds. The battle for your money. Actively managed funds have a team of managers who are actively buying and selling stocks, trying to beat the market and generate the highest returns possible. Index funds, on the other hand, simply track a specific market index, like the S&P 500. They don't try to beat the market, they just try to match it. Historically, very few actively managed funds have been able to consistently outperform the market over the long term. Plus, remember those high management fees we talked about. Index funds have much lower fees because they require less active management. This means more of your money stays invested and working for you, which can lead to significantly higher returns over time. Chapter 5. The Taxman cometh. Why tax efficiency matters in mutual funds. When it comes to investing, it's not just about how much money you make, it's about how much money you get to. And that's where tax efficiency comes in. See, Every time you sell a stock or a mutual fund for a profit, you have to pay capital gains taxes. Now, some mutual funds are more tax efficient than others. Index funds, for example, tend to be very tax efficient because they have lower turnover rates. Actively managed funds, on the other hand, often have higher turnover rates, which can lead to higher taxable distributions. So, when you're comparing different mutual funds, be sure to factor in tax efficiency and consider holding your investments for the long term to minimize the impact of taxes. Chapter 6. Load fees. The sneaky charges you need to avoid. Let's talk about load fees, shall we? These are basically sales charges that you might have to pay when you buy or sell certain mutual funds. There are two main types of load fees: front-end loads and back-end loads. Front-end loads are charged when you buy shares of a mutual fund. So, if you invest $10,000 in a fund with a 5% front-end load, you're essentially losing $500 right off the bat. Back-end loads, on the other hand, are charged when you sell shares of a mutual fund. Now here's the good news. You can avoid load fees altogether by investing in no-load mutual funds. These funds don't charge any sales charges, which means more of your money goes directly into the market. Chapter 7. Diversification. Don't put all your eggs in one basket. You've probably heard the saying, "Don't put all your eggs in one basket." Well, that applies to investing too, especially with mutual funds. Diversification is the key to managing risk and maximizing your chances of success in the long run. Mutual funds typically invest in a basket of different stocks or bonds, which helps to spread out your risk. However, it's still important to diversify your mutual fund holdings themselves. Chapter 8. Dollar cost averaging. The power of consistency. Let's talk about a powerful investing strategy called dollar cost averaging. This strategy is all about taking the emotion out of investing and building wealth steadily over time. Instead of trying to time the market and invest a lump sum of money all at once, you invest a fixed amount of money at regular intervals, regardless of what the market is doing. The beauty of dollar cost averaging is that it takes advantage of market fluctuations. When the market is down, you're buying more shares at a lower price. And when the market is up, you're buying fewer shares at a higher price. Over time, this strategy can help to lower your average cost per share and potentially boost your returns. Chapter 9. Decoding the matrix. Using mutual fund ratings to your advantage. All right, let's talk about mutual fund ratings. These ratings can be a helpful tool when you're trying to make sense of the thousands of mutual funds out there. But it's important to understand what these ratings mean and how to use them effectively. There are several different rating agencies, such as Morningstar, Lipper, and Standard & Poor's. Each agency has its own methodology for evaluating mutual funds, but they typically consider factors like historical performance, risk, expenses, and management team. So it's important to use these ratings as just one piece of the puzzle when you're making investment decisions. Chapter 10. The importance of reviewing and rebalancing your portfolio. Now that you've learned all about choosing the right mutual funds and investing strategies, it's important to remember that investing is not a set it and forget it kind of thing. You need to regularly review and rebalance your portfolio to make sure it's still aligned with your financial goals and risk tolerance. Life happens, things change, and your investment portfolio needs to adapt accordingly. At least once a year, take some time to review your mutual fund holdings. If you find that your portfolio is no longer aligned with your needs, don't be afraid to make adjustments. Thanks for watching. If you found these hacks helpful, make sure to hit the like button and subscribe for more tips on how to make the most of your investments. Remember, investing doesn't have to be complicated or intimidating. By understanding the ins and outs of mutual funds and following these simple money hacks, you can take control of your financial future and start building wealth like a pro. Leave a comment below with your favorite money hack or any questions you have about mutual funds. See you in the next video.